you're looking at here in front of you is a 3-year chart of the Russell 2000. It is down 14 percentage points in the last 3 years. This shows you the performance of the Russell 2000 so far this month. It is down 7.5%. It is far worse than the Dow, the S&P 500, or the NASDAQ. We have small cap stocks all over the place that have just been completely falling apart this year or doing very poorly compared to what the company's actually doing. You look at a stock like Fubo, down 55% year to date. Honest, which reported the best quarter the company reported in years, even despite that, that stock's down about 4 percentage points so far this year. Nordstrom, there's a lot of talk about Nordstrom's going to get bought out this year. And even with that huge amount of excitement, that stock is still negative for the year. SoFi is not a small cap stock, but it kind of gets put in that category of smaller stocks in general, especially when it comes to banks. And yet this stock is down about 26% this year. You look at a stock like Avant, the company reported record Q1 net revenues and they beat their guidance, and that stock doesn't matter. They could have the cure for cancer and it still wouldn't matter. That stock's down 44% so far this year. And yet you look at the big dog stocks and they are just performing tremendous. You got a stock like a Meta up 40% this year. You have a stock like Nvidia up 71% this year. I thought today's a day. Let's talk in depth about small cap stocks. I'm feeling very passionate about this here today. I think it makes sense. These stocks, let's be very crystal clear, they're in the depression state. The depression state when it comes to these stocks right now. I want to talk about these. I want to talk about why these stocks have sucked so bad, to just put it quite frankly to you guys, okay? We're going to talk about when will these stocks go beast again? And they will go beast again. But when is that going to happen? I'll take you through the scenarios on how that happens, when that happens. And then we're going to talk about why I'm investing in some of these small caps. These small caps have held me back the last couple of years. If I would just have my money in the big dogs, I would be doing far better, right? Why not just have my money invested in Meta, Nvidia, the stuff that's working, right? We'll speak about that in this video as well. Okay, there's an in-depth beast here today. I spent the last many hours preparing this video for you guys. So I thought this would be an important video to do here today. All I ask in return, smash that like button and make sure you are subscribed here to the channel. That is all I ask from you here today, okay? Alrighty, guys. So let's get into this. Let's talk first about these two subjects. Let's talk smalls and let's talk why they have sucked so bad, okay? So if you need any more proof of how bad these stocks have performed, look at a 3-year chart of the Russell versus S&P 500 and versus the NASDAQ. This is absolutely incredible. There's a 34 percentage point underperformance of the Russell versus the S&P 500 and a 40 percentage point underperformance of the Russell versus the NASDAQ. Now, I looked back throughout data, okay, and throughout many, many decades, and guess what? I could not find a 3-year span where the Russells underperformed the S&P 500 by 34% and where it underperformed the NASDAQ 40% over a 3-year span. I couldn't find it. I'm not saying it doesn't exist. Maybe I missed it somewhere in there, okay? But based upon what I look back at everything, I could not find a 3-year period where that happened. That is incredible. This is not normal. This is the furthest thing from normal, just to be quite frank, okay? This is not, look back at the previous 3 years, look at back at the previous 3 years, previous 3 years, previous 3 years, previous 3 years. You're going to find this is not normal, folks, okay? Now, there's some reasons for this, right? There's many reasons why this has transpired. Pretty much, once in maybe your generation situation happening right now in front of our eyes, right? Here's the first reason. Small caps are seen as more interest rate sensitive. Now, that's true in many ways. It's not true across the board. There are some situations where it's not, right? But small caps are seen as more interest rate sensitive. So when interest rates rise quite a bit, it's seen as hurting small caps more. And the reason being is small caps, if they have to take on debt, it's going to be at much higher rates, and small caps might pay a much bigger interest rate than, let's say, a large company would, right? And they might not have as much cash around as the big companies have, so they can't get that interest income like the big dogs can. Think about it in terms of like a family, right? You have a middle-class family that has a household income of $100,000 a year. Well, the thought process is they're going to be hit much more by interest rates going up than, let's say, a family that has a household income of $1 million a year, right? Because a family that has $1 million a year, generally speaking, they should have a lot more cash around, so they should be able to generate interest income. They might not even have to take out any debt, right? Versus a family that brings in $100,000 a year, they want to go buy a car, they got to buy it on debt, their interest rate is going to be very high, right? They want to go buy a house, Here's your 7.5% mortgage rate. You want to go have some credit card debt, you're paying, 25, 30% credit card interest rates, right? And this family, they say, I don't need to pay those rates. I paid my credit card off right away, right? I'll buy a car cash. I don't need to take out a loan to buy a home, right? Those sorts of things. So that's the thought process. And to be quite frank, a lot of it's true, right? Once again, sometimes this family might not take any debt. They don't care about credit cards or having a car loan or a home loan. So they might not be affected. But generally speaking, these people are going to be much more affected by interest rates going up than these people. If anything, these people actually benefit from rates going up because they generate so much money, they have so much cash, and that cash can then earn 5% interest rates, right? Now, also, small caps are seen as handling inflation worse than large caps, right? And I take you back to that family example of even like if we judged people on this, right? A small cap person versus a large cap person, well, guess what? The small cap person gets hurt a lot worse by inflation. The family that makes $1 million a year, if the price of milk goes up 30%, it doesn't even register. If the price of eggs go up 50%, it doesn't even register. If the gas prices double, it doesn't even register to the family that makes $1 million a year. However, the family that makes $100,000 a year, it makes a substantial difference, right? The same exact is true for small cap companies versus large cap companies. Large cap companies may not register that much in terms of how much it negatively affects a large cap company. Small caps can feel it very heavily. Now, here's the issue, the big issue. Inflation is still an issue, factually, right? The Fed wants to see CPI around 2%, right? So it wants inflation to be where that green line is. We're not there, and we're actually trending up, if anything, recently, right? And so we have still an inflation problem, which means we're higher for longer, which means all these negative effects of small caps are going to continue to be seen, at least in the short term, which is very different than the view was, let's say, 6 months ago, 12 months ago, when people thought inflation had been beaten and we'd be getting lower rates sooner rather than later. Now it's like, now people are talking about 0 cuts this year, 1 cut this year, right? I'm starting to hear that talked about a lot on CNBC now at this point in time. A lot of these Wall Streeters that go on there, a lot of those folks were at 4 to 6 cuts this year 6 months ago. And now a lot of those same people are now talking about 0 cuts, 1 cut, maybe 2 cuts. Now, if you have 3 cuts priced in for this year, you're like seen as like kind of insane. That's how much things have changed, right? Now, to be quite frank, this is somewhat true as far as small caps, handling inflation worse than large caps, right? You look at, let's say, Honest versus a Procter & Gamble. They both sell very similar products. And you look at Honest in 2022 when inflation was out of control. When inflation was out of control, Honest stock tanked. It went down over 50% in 2022, right? Procter & Gamble, on the flip side, Procter & Gamble did decent. I mean, Procter & Gamble was only down 5% in 2022. That's a win. That's a big win. Now, next up here, there's a viewpoint of safety in large caps over small caps. Now, I think a lot of this comes back to just human nature, just feeling better with large things and small things, right? I want to be with the big bank rather than the obscure bank that only has 2 locations. I'd rather be with the bank that is nationwide, right? Safety over with the large over small, right? And I mean, if there was a zombie apocalypse and I gave you these 2 homes to go into, I bet you if we were in a zombie apocalypse, 90% plus of humans would choose to go into this home right here versus this home. And the viewpoint is they would feel like there'd be safer in there. There's more places to hide. Maybe there's some reality in that. Or maybe that's just a bunch of crap and they'd be found anyways. It would just, maybe they'd be found, not as quickly as if they were hiding in this house right here, right? But that's a viewpoint. And so that's how people feel. They feel like, okay, if there's a crash, if something bad happens, I'm gonna weather the storm better here than versus in this little thing right here. If I told everybody, hey, there's a big tornado coming, which house you're gonna be in? 90% plus of people are gonna choose this house. Like, it's just human nature, okay? Now, after taking you through that, we can find there's reasons why this insanity has occurred. Several reasons, right, that we just went through. So it's not like this is for no reason. There are reasons why this has happened. So now let's talk about when these stocks are going to go beast, what the scenarios are, and then we'll get into why I'm investing in some of these smalls, some of my favorite smalls, and those sorts of things, okay? So scenario number 1, there's 3 scenarios that could play out that would cause small caps to absolutely go on an epic run here, okay? The first one is if interest rates start to go down and there's no massive recession occurring, okay? So let's say the Fed does start lowering rates this summer, into the fall, and into the beginning of next year. And guess what? There's no major recession, right? Maybe growth isn't super strong, but there's no major recession. Well, that would be an environment that would be very conducive to small caps, especially if we could start seeing CPI simultaneously all in the twos. If we could start seeing CPI in the twos with interest rates dropping and there's no major recession occurring, that would be a very Goldilocks scenario for small caps, and you would see those stocks go on an absolutely epic run in that scenario number one. The second scenario is a scenario where big tech and large caps kind of get played out. So let's say the Metas, the Nvidias, those sorts of stocks report another great quarter, another great guidance. Those stocks go on a beast run. Let's say the Nvidia goes to 1,000 plus, 1,200, something like that. Let's say Meta goes 550, 600. And, let's say Google reports a great quarter, Microsoft, those sorts of stocks. But then there starts to be a view of those ones kind of getting played out a little bit. Maybe they push the valuation too much. Maybe growth is going to slow, something like that in the back half of the year. Then you could actually see some rotation of money coming out of some of those stocks and kind of rotating into the small caps, especially if scenario one is looking somewhat realistic. That would just add more fuel to the fire. If people started to feel like these are kind of played out and they start to rotate out of these in the back half of the year, right, which is basically, let's just call it summer and after, and you get this sort of scenario, that's just kind of fuel for the fire there. So it's scenario number two. Scenario number three is a scenario where the market starts to go major risk on, right? Right now, short term, we're kind of in a little bit of a risk-off market. Remember, I showed you how bad the indexes have performed so far this month. So right now, we're kind of getting a correction in the market. It's going to be, especially if this keeps going, it'll be like a little mini correction. But let's say we get past that, okay? Everybody does their kind of sell in May and go away type phase, and they all try to get in before that. And let's say we actually start to go risk on this market in 3Q 2024 through like the first quarter of 2025. And let's say things start playing out for us. Next thing you know, all of a sudden we see CPI in the twos in the summer, somehow, some way. I don't know if that's going to happen, but let's say it happens, okay? And let's say the Fed starts talking really dovish, they get super dovish, and they actually start lowering rates. That could cause, especially if there's no recession, that could cause a scenario where people start wanting to go very risk on, right? And that's a scenario we actually saw play out in 3Q 2020 through the first quarter of 2021. We had that initial recovery, in the Rona, after the Rona crash, right? That really, kind of went on in the second quarter. But then that slowed down a bit. And then third quarter, fourth quarter, we saw kind of just a crazy kind of boom cycle there. Risk on assets went insane. Next thing you know, some of these stocks were 3Xing, 5Xing, 10Xing in quick amounts of time. I mean, we're talking in the matter of months. And if you see something like that play out, then definitely people, are going to be piling in, because at the end of the day, when people see a lot of money being made, they pile in to where the money's being made. It's, once again, goes back to human nature, right? And so if a scenario like that played out, people chase smalls for performance in that sort of scenario, right? Because they start looking and they say, okay, I'm an Apple. Apple's hardly giving me any returns, but I could be in the small cap over here that just doubled over the past 3 weeks. Let me get into that one. Then you attract all the trader money over there, and you even attract some long money that starts to look at some of those opportunities. And at the end of the day, deep down, they want to be part of that money-making opportunity, right? So that's a third scenario that could play out there, is a big risk-on market if that was to play out, okay? Now, why am I invested in these smalls? Why am I not just going all in, Meta, Nvidia, those sorts of stocks, right? So these stocks have performed horrible. Some of my favorite stocks of the bunch are Fubo, which has been absolute trash as far as the stock performance. The company's metrics are getting better and better and better. Losses are coming down, revenue's going up, subscribers are going up, margins are getting better. Everything's going in the right direction for the company, but the stock price is absolute trash. No one wants to be in Fubo right now, right? It is like the type of stock no one wants to be in. And so that's going on, right? I really like Avant. I mean, the stock's down 43%. This is a type of stock no one wants to be in right now, right? Here's the deal. Avant just had gross revenue outperform. It was incredible. They achieved $8.9 million in gross revenues, outperforming the guidance range of 8.2 to 8.7 million. Revenue growth came in at 15%. International expansion, the global sales were up 21%. They're getting their profitability in a much better place for that company, but no one cares about it right now, right? I like it. I like it a lot. Revolve, another small cap of mine. This one's doing decent this year, up 15%, but not up nearly as much as it could be, because right about here is where people started worrying more and more about, oh, the Fed, they might not be done, right? And so Revolve, really like them, like their earnings, like their numbers, kind of where things are going to be trending over the rest of this year. Honest, I mean, this stock's, the company's fundamentals are the best they've been since it's been a public company. I'll just be quite honest with you guys. And yet the stock has done nothing so far. I really like Honest. The Planet, I think the Planet's in full-blown turnaround mode. Stock's only up 9% this year. Should be up a lot more than that, but once again, no one wants to play these sorts of stocks. So here's the deal, okay? Why am I investing in these sorts of stocks, right? Well, here's the deal. Look at a stock like Fubo. Now, if you think about where people start to feel good about inflation data and where they start to feel like, you know what? The Fed's going to probably be lower, and people even start talking about the Fed lowering in the back half of 23, beginning of 24, right? And that really started around April of last year. And if you look at Fubo's performance over that time, the stock price went up 200 percentage points in about 9 months, about 8-9 months. That's incredible. 200% in about 8 or 9 months. If you look at a stock like, this is Honest here, Honest over that same period of time went up about 73 percentage points, right? So when the moral of the story in regards to this is when people start feeling good about Fed cutting, people start to position into these sorts of stocks and they start to go beast mode, right? And anything that is positive from the company's angle is just seen as kind of like extra fuel for the fire to kind of pile into these sorts of stocks. In the moves, I mean, guys, when these stocks move, they freaking move. That's to the upside or the downside. We saw the downside this year, right? But we've also seen the upside where, I mean, whether the stocks are going up 200% in like 8 months, 9 months, right? Look at Honest. Honest went from $1 to $3. That's a 200% gain in a few weeks. Literally in a few weeks that happened. When momentum comes into these names, it is dramatic. It's not like, oh, the stock went up 10%. No, it's like, oh, the stock went up 100% in 5 trading days. Oh, the stock went up 300% in 3 months. Like that's the type of moves we're talking about in regards to these stocks, right? So if we think about my portfolio overall, I'm invested into a lot of very large companies. You think about Tesla, it's a major investment of mine in the public account, $264,000. And keep in mind, this is during a time period where Tesla stock's down heavily. If Tesla stock gets anywhere close to where it used to be, just a few years ago, I mean, then we're talking about it's over $500,000 position easily in that portfolio, right? That's just getting back there. It's not even talking about setting a new high. Meta is a huge position for me, $840,000 in the public account, right? I have a stock like Amazon, $191,000 I have in that particular stock there. If we look at a stock like Palantir, which isn't really a large cap, but it's larger market cap, right? $118 billion. So I'm heavily invested into a lot of very large companies. Some of my other companies I own in the public account that are very big dogs, NVIDIA. I've also been buying Nike very heavily recently, right? And so I own a lot of large caps. I'm very exposed to a lot of large caps. And I believe my large caps are some of the most quality large caps in the world. They're the type of stocks I really want to be in over the next 5-10 years, right? But let's be quite honest about my big dogs. They're not giving me a 3x to 10x opportunity over the next 1 to 2 years. They're just not. Is Meta going to 3x over the next 1 to 2 years? No, I wish it would. That'd be awesome. I'll be clapping all the way, baby. Go to a $2.4 million position, $3 million position, $5 million position. I would love that. It's not happening. Is, as much as I love Tesla, is Tesla 3x into 10x over the next 1 to 2 years? No. Is Nike 3x into 10xing over the next 1 to 2 years? No. Is Amazon 3x into 10x over the next 1 to 2 years? No. Like those stocks aren't those sorts of companies, right? They're great companies. They should produce me very good gains over the coming years, but they're not those sorts of return profiles, right? My small caps are that opportunity. They are that opportunity to make substantial amounts of money, like crazy money in a very short amount of time. And we already got a glimpse of it. We got a glimpse of it last year when you watch those stocks go up hundreds of percent in a matter of weeks or months. There was like a little, hey, remember this can happen. That was that little phase there. And right now we're going through the other phase of like, hey, remember this can happen on the downside as well, right? So that's why I'm investing in these stocks. Because a lot of them I think have some pretty bright futures. And if things play out the way I think they can play out for these companies, the stock price is going to 5x, 10x in a short amount of time. We're not talking about a long period of time, right? Now you might say, okay, if you feel like that, why not go super heavy on these type of stocks? And I think that's a fair question, right? If a Fubo, if an Honest, if one of those sorts of companies really are that opportunity, why not go super heavy, okay? And I want to talk about that in depth here, okay? So let me take you to 1000xstocks.com. This is my own website I created over the last quite a bit of time. And the reason I created this website is I wanted a website where I could it would cut down the amount of time massively in terms of me making investment decisions or, understanding stocks. So I had this website designed essentially that it gives me all the metrics I really care about, a massive amount of metrics, and it gives me out in a way that tells me exactly where these stocks usually trade at, where that stock's trading at. And I also put in a compare feature so I can compare a bunch of different stocks against each other. And I also added a conference calls feature so I don't have to go to company's investor relations page. I can literally just listen to conference calls right on 1000xstocks.com. It's phenomenal, right? And so it saves me a ton of time. And I want to take you in this tool to kind of show you a little bit of why I can't go insanely heavy on these small caps, okay? So take a peek here, okay? If I compare, let's say, a Meta to, let's say, a couple of my small caps that I'm very bullish on over the next few years, an Honest, a Fubo, right? Well, what do we see? We see some problems here, okay? Meta actually has a trailing 12-month PE. Meta actually has a forward PE. Meta is extremely profitable. Meta is going to be extremely profitable in any sort of environment you throw at it. Throw inflation at Meta, they're doing just fine. Throw a recession at Meta, they're doing just fine. It doesn't really matter what you throw at Meta. Sure, there are going to be some time periods when revenue growth is going to be stronger for the company. Sure. Are there going to be some time periods where profit growth is going to be stronger for the company? Sure. But at the end of the day, it's the number one service that you have to use if you're going to advertise as any business in the world. Facebook, Instagram, you got to use those. WhatsApp on the messaging side is becoming very helpful to a lot of businesses as well, right? And then we got Threads additionally there, right? So this is a type of business that throw whatever at it, it's good. Honest and Fubo, meanwhile, they don't have trailing 12-month PEs on them. They don't have forward PEs. I do think there's a realistic possibility Honest could actually make a profit this year. Fubo, no. Fubo's not making a profit this year. Maybe the following year, then we can talk, but not this year, not for Fubo, right? Honest, maybe. But that's a maybe. That's like, let's call it like a 50-50. And that's just a small profit if they do make a profit, right? So that's a problem versus a Meta, right? If we think about the balance sheet, Honest has got their balance sheet in a lot better place. Do they have a Meta like balance sheet? No, it's not even remotely close. Like Meta's loaded with cash to the sky and little to no debt. A company like Fubo, is their balance sheet great? No. Is it the worst? No. But is it a Meta type balance sheet? No, not even remotely close to that sort of great balance sheet, right? So there's inherently a lot more risk with these sorts of stocks. And we don't know exactly when the Fed's going to start to lower and the environment's going to get better for these small caps, right? Think about that for a moment. How many Wall Street professionals thought the Fed was lowering rates this year? Almost all of them. I mean, pretty much literally every single Wall Street professional. Every single macroeconomic expert in the world thought rates would go lower this year. And now people have switched just in the past 4 to 6 months about feeling like rates would go lower this year to now starting to think maybe they're not going lower this year, right? So that kind of goes to show you that we don't know exactly. We can think, maybe the Fed's going to lower the summer, maybe the Fed's going to lower in the fall. But we don't know for sure, right? All we know is inflation is being sticky. Inflation's being an issue for us. So that's some food for thought. If we look at a company like Meta's gross margins, they blow these companies out of the water. Fubo had negative gross margins for a long time. Fubo just finally, in the past few quarters, has got the gross margins to be in the positive. And they're trending up and things are getting better there. Honest's gross margins were horrible. Those are starting to improve. So that's good. But are they even anywhere remotely close to a Meta? No, not even in the same league, right? Look at a metric like net margin. Look at the net margin of Meta. It's sickening. 30% plus. Honest, just in the past quarter, finally had a positive net margin for the first time in literally years. That was incredible. That was great to see. Fubo's got a huge negative net margin right now because they're losing money on their bottom line. That should hopefully get taken care of over the next year and a half. But for right now, they got a negative net margin. So when you compare these companies, you can clearly see there's perceived safety. And there's safety for a reason. And this is why a stock like Meta has performed so tremendous over the past 18 months. And why stocks like Honest and Fubo have fluttered over the past 18 months. Because people, even though Honest's numbers have got so much better over the past year, even though Fubo's numbers have gotten so much better over the past year, until you get solidly profitable in the given market we're in, people don't care. If people cared about revenue growth, if that was what was valued heavily in this market, stocks like Honest and Fubo would do tremendous, especially Fubo with the type of revenue growth they put up quarter after quarter after quarter. If that's what mattered, Fubo would be $30 a share right now, $50 a share. But we're not in that market. We're in a profit market. And that's why Fubo's $1 a share right now and not $30 a share, $50 a share. When everybody cared about revenue, Fubo was like $50 plus a share back then. So this is where you kind of understand the market you're in versus the market you were in 3 years ago versus the market you could be in 3 years from now. There's a substantial difference there, right? Now, we look at something like the trailing 12-month price-to-sales ratio, and all of a sudden you start to really understand how potentially undervalued these companies are. Look at a Meta, trailing 12-month price-to-sales ratio of over 9. Look at Honest, trailing 12-month price-to-sales ratio of 0.87. Fubo, 0.3. And that's on a trailing basis, right? Remember, Honest should grow revenues very nicely this year. Fubo should grow revenues double digits this year. So when you think of that from that context, holy smokers, this ain't no dang jokers. That's why these stocks are explosive, and that's why whenever the time comes and this market starts to like smalls again, these stocks will go beast mode. And they will reach some insane numbers that it will blow everybody out of the water and then be like, what in the world is going on, right? But for right now, we're in the depression state of these stocks. No one wants a piece of these, and that is what that is. But remember, things can change very quickly in the market. It can change very quickly. In a matter of 6 to 18 months, the market can look at things totally different. I take you back in time 18 months ago. 18 months ago, what was I getting Meta shares for? $88? Somebody sold me Meta shares at $88.94. I literally have those shares in the public count, right? Like, come on. No one wanted a piece of that stock. That was a given market we were in that time, right? And now people can't wait to run. People are excited. Oh, Meta dipped under 500. Yes, let me buy it. And yet you couldn't find these same people to buy the stock when it was under $100. Like, isn't that incredible to think about that, right? And now they're like, yes, it dipped under 500. I got to get some shares. 494, baby. Woo, 497. And don't be surprised if people are paying 550, 600 very shortly for Meta, right? So when I look at stocks like Honest, people might not want to pay $1, $3 for these stocks right now. 18 months from now, they might be willing to pay $5, $10, $20 for these stocks. It changes quick, given the market you're in. And then if the fundamentals of the companies continue to improve, while that's all going on, that's when you get an insane kind of super cycle there, right? And so that's why I remain invested in these sorts of stocks. That's why I remain bullish on them over time. But it's very clear because of the given market we're in, people don't want a piece of these stocks. But things change, man. Things change. And, that is what it is. So that's small caps. That's why they have sucked bad. This is also the scenarios that could cause these stocks to beast. And that's also some of the smalls I liked. I shared in this video as well. And that covers small caps, folks. I hope you really enjoyed today's video. All focused on small caps here today. I just opened up my tool for the waitlist, okay? 1000xstocks.com. You can go to that. You can apply for access in there. We're going to have monthly memberships, and we'll also have yearly memberships for that if you want to use that tool. I've been using it behind the scenes for quite a while. I spent a lot building this tool, and it's pretty sick. And I got more things I'm adding to it. It's the tool that I want. Like literally the way I've designed everything is like, this is how I want it. This is how I want it to be laid out. This is why I need it like this. And man, it's been fun. It's very expensive though. I will say that it's not cheap to build a tool like this, but it's cool to build your own website and have everything exactly how you want it. I love it, man. Love it. So yeah, if you want to join the waitlist over there, 1000xstocks.com, you can go ahead and join the waitlist. Much love and have a great day.